Thank you for that introduction. If you're here for Taxes in Retirement 567, you're in the right place. I'd like to start with a question. What keeps you up at night? If you're like many of us, you're concerned about the current environment. Maybe you're worried that tax rates will continue to increase to pay for all the spending we've done. Maybe you're concerned around healthcare and the exploding costs of long-term care. Perhaps you're concerned about passing on your life's work, everything you work so hard for, to the people you care most about and not the rest of us. Perhaps you're worried that when the market drops again, you may lose a large portion of your wealth, perhaps like you did during the last financial crisis. Well, I'm here today to help you sleep better at night. I'm here today to spend the next hour answering some of those concerns that you think about perhaps right before you fall asleep at night. My name is Neil McGrath. I'm the Managing Director of Carson Wealth here in Pittsburgh, and I'm here to provide value to you with the short time we have. Now, with that said, I'd ask you to consider looking at that chat box on the side of your screen, putting in those specific questions that you may have. Don't worry, only we can see those questions. I will attempt to address those throughout this presentation, and a member of my team will be on that chat box trying to answer those specific concerns, and will also provide you an opportunity to speak with us individually. Once again, my name is Neil McGrath. This is Taxes in Retirement 567, and we're here to help you figure out the answers to those questions. You know, I've been doing this a long time, over 25 years. I've owned tax planning firms. I have CPAs and other professionals on my team. What I found is that most people don't really know if they're paying the least amount of taxes as they should be. And the reason I think that is because most CPAs, most tax preparers are in the business of recording history, of looking in the rearview mirror and letting you know what deductions, exemptions, or credits you may receive. Very few are doing the proactive planning and letting you know if you do this strategy or that strategy, you may save money in taxes this year, down the road, or maybe for your children, for example, eventually. I'm located in the Pittsburgh area. We have multiple offices. That's Pittsburgh, Pennsylvania. And I have a team of professionals, again, some on the presentation today, to help answer those questions you have. So what are we going to talk about? Well, everyone that I've ever met with, whether they had $15,000 or $15 million, really had these four concerns. Number one, they wanted to make sure they never ran out of money. That's universal. Number two, they wanted to make sure they're paying the least amount of taxes as they can, no more than their fair share. Number three, they want to make sure that if something happens to them and they are married, for example, that their spouse is going to be okay. And if they're not, that they will have the right care in place. And finally, they want to make sure the assets they have pass on to the people they care most about. So we're here to answer some of those questions for you. Again, I live in Pittsburgh. I'm here with my wife, Ann McGrath, who happens to be an estate planning attorney, and my three young children. There are the necessary disclosures. Feel free to review those. And keep in mind, during the introduction, they mentioned some handouts that are going to be in this presentation. We'll have a full copy of the presentation, as well as some additional important information that you may find valuable. So what are we going to cover today? Well, a lot, I hope, with the time that we have. There have been so many tax changes over the past several years that we're going to get into those. But before we discuss the specific tax law changes, I'd like to tell you why it's so important to me. You know, this is all I've done. This is my life's work. And I'd like to tell you more about my story. My mother came here in the 1970s to Pittsburgh, Pennsylvania, from a developing nation with a 6th grade education. She made every financial mistake that one could make. Now, the reason I share this with you is I witnessed those mistakes, and it was always important to me to be smart about money so I could help my mother. She had advisors and accountants and insurance agents and attorneys, and none of them worked together to provide her the best financial outcomes. In fact, even though she did eventually go to college and have a very successful career in financial services, banking specifically, she never felt confident about her financial decisions. So that's why I chose to make this my life's work. And it's all I've ever done for over 25 years, is helping people just like you. So what are we going to cover today? Again, I've done a lot of these presentations. We're going to start with some basics. Hang in there. It's only going to take me about 7 or 8 minutes to get through the foundation that will provide you the information you need to really understand the strategies that we are going to recommend you consider. Then we're going to talk about some of these tax law changes. The 2017 Tax Cuts and Jobs Act, 2019 Secure Act, Secure Act 2.0, which just passed in 2022. We'll let you know how that affects you, good or bad, and how you might plan for the most efficient outcomes for your family. And most importantly, with the time we have today, I'm going to give you specific strategies that you can implement on your own, perhaps with your advisor, or perhaps with us. So that's our agenda today. That's what we're going to cover. But before we get there, I'd like to start with a question. And I know I see some people writing in the chat box right now their questions. So I see a lot of people are on here. So when I say the answer that you want to choose, just enter that in the chat box. So here's the question. What was the U.S. highest marginal tax rate in history? Was it 50%? 67%? Again, just write your answer in the chat box. I see some people putting their answers in there. 72%, 94%, or 100%? Yeah, some of you got this right. Yeah, I see that. Very good. Yes, most of you got it right. 94%. Do you believe that? There was a point in time when the U.S. highest marginal tax rate was 94%. So why do I share that with you? Well, tax rates change, and occasionally they change dramatically. So one of the things that we're going to try to accomplish for you today is how to keep your marginal and effective tax rates lower. So again, most of you that at least entered in an answer got it correct, and I'm sure nobody looked at the presentation ahead of time, so kudos to you and a great job. Before we get into the presentation, I just want to share with you a couple reminders. Number one, I'm not here to read to you every single slide. It's not valuable for you. I've included the full presentation as a handout on the side of your screen. I'm here to focus on examples and strategies to hopefully give you some ideas on save money in taxes. Number two, I'm gonna ask for a little participation. We have a couple questions we'll ask along the way. You're gonna have questions or need clarification. Use that chat function on the side of your screen to get those questions answered. Number three, a lot of our examples are married filing jointly. Please know, we work with single folks. We have many of them as clients. I simply chose that demographic today in the interest of time. And finally, yes, you'll have an opportunity if you want to speak with one of us to get your questions answered. We'll let you know how to do that before we're done today. So let's get started. Like I mentioned, we're going to start with the basics. So hang in there. I promise we'll get to more interesting strategies, but I've done dozens of these seminars and webinars, and I know we need to create a foundation. So what you're looking at on your screen right now are the current marginal tax rates for married filing jointly. A lot of the examples I use today are going to be for married filing jointly. Doesn't mean we don't work with single people or we don't like single people. We simply had to use one demographic for this presentation. So again, this is the marginal tax rates, but I'd like to draw your attention to the difference between marginal and effective tax rates. Let's assume you had $50,000 of taxable income. Which tax rate would you be in? Go ahead, put it in the chat box. Okay, a couple of you answered. Yes, 12%. However, we are in a progressive tax system, so the first roughly $20,000 is going to be taxed at 10%, and the difference between the $20,000 and the $50,000 in this example will be taxed at 12%, meaning your effective tax rate is less than your marginal tax rate of 12%. Again, very basic stuff, just want to get through some of this information. Now, next, let's talk about capital gains. I'll start with a question. Are capital gains taxed differently than ordinary income? Well, the answer is yes. The government has a goal to incentivize us as citizens to invest our money. So one of the ways they help with that is they tax those profits at a lower rate. So capital gains tax rates, if you had less than roughly $80,000 in taxable income, you're in a 0% capital gains rate. $80,000 to roughly $550,000, 15%, and above that 20%. So it's very important to know there is a difference between ordinary income and capital gains taxes. Oftentimes what we find is we meet with people, they have profits in stocks that they've owned for a long time, or maybe mutual funds, and they know they should take some profits or chips off the table, so to speak. However, they don't want to pay taxes. Well, if we're doing the proactive planning, projecting out their taxes, often we can take those profits tax-free. Deductions, exemptions, and credits. I won't spend a lot of time on this. I just want to mention one of the big changes from the 2017 Tax Cuts and Jobs Act. That increased the standard deduction for all of us. In fact, if you're married filing jointly, your standard deduction now is around $28,000. Well, what does that mean? Most of us then will no longer itemize. Perhaps you gave a little bit of money to your church or the Animal Rescue League. You no longer may get a tax deduction for that. So there are benefits to having an increased standard deduction, but there's also other strategies you might want to consider for things like your charitable intentions, and we're going to talk about that as well. All right, we got through some of the basics: ordinary income, capital gains, standard deductions. Now we're going to get into some more what I think are interesting topics and maybe a little bit more complex. Many of you may be familiar with the term required minimum distributions, or RMDs. Essentially what that is the IRS says, hey, we let you defer our tax money long enough on those IRAs and 401ks. Whether you need the money, want the money, we're going to force you to start taking it out at a certain point in the future. Here's a question, and again, just use that chat function on the side of your screen. What age do you need to begin taking RMDs? 67? Couple of you put 67. 70 and a half? Okay, all right, 70 and a half, I see that. 72? 73? Or 75? I'm getting a lot of participation, so thank you. So most of you landed on age 72, and I can see why. However, the real answer is it depends. And the reason it depends is not only because they've changed that age so often these past few years, but depending on when you were born, dictates when you need to start taking these required distributions. So prior to the Secure Act of 2019, that age was 70 and a half. Then Secure Act 2019 occurs, they make it 72. And then Secure Act 2.0 of 2022 occurs, and for some of us, it's 73, and still others, it's 75. So if you're a little confused, you're not alone. And it's important because there is a penalty if you don't get it right. So just to make it even more complex, the IRS has not only changed the ages dramatically over the past several years, but that percentage you're supposed to take out changes every year. And presumably the balance of those IRAs and 401ks changes every year. So required minimum distributions is a big planning area. And I'll tell you what we see all the time, and maybe you're in a similar position. You worked really hard, you've been fortunate, you saved some money, you have that big 401k, you have some taxable mutual funds, you have some cash. Well, if you haven't projected out what you're going to be forced to take out in the future, you may be in for a really not good surprise, because you may be forced to take out way more money than you want or need at who knows what tax rate that you'll have to pay taxes on. So part of this planning we do for our clients, and it's really important because no one else seems to do it, is we project out those required distributions. And then if we do that, we can figure out if it's more money than you might want or need, and perhaps give you strategies on how to reduce those required minimum distributions. So if you've been around long enough, and I'm guessing most of you on this webinar have, you know that when the IRS gives you something with one hand, they take away something oftentimes more important with the other. And that's what this slide is referencing. And that's the elimination of the so-called stretch IRA. So I'm going to give you an example to help you understand this a little bit more. Let's assume that you worked really hard, you live a long time, you pass away, and you leave your $1 million IRA to your 40-year-old daughter. Well, prior to the Secure Act of 2019, your daughter could take out a required minimum distribution on that $1 million over her lifetime. So perhaps that's $20,000, $30,000 a year over her lifetime. She could continue to defer those taxes and presumably not create a large tax issue. However, once Secure Act passed, they removed that stretch IRA and now force you to take that out over 10 years, or force your daughter in this example. So instead of taking out, for example, $30,000 a year over 30 years, she now has to take out $100,000 a year over 10 years. So her tax liability is going to be significant, maybe at her peak earning years. So that's the elimination of the stretch IRA. And I'm going to give you a strategy here in a moment that can perhaps save your family and you hundreds of thousands of dollars or millions of dollars in income taxes. And that is Roth conversions. So Roth conversions are a strategy we use all the time for certain clients in a situation like the example I just gave. So let me walk you through how that works and why it's important. So again, that stretch IRA is going away, and I think it's important for you to understand how that might impact your family. So one of the things that we can do for certain clients is, again, a Roth conversion strategy. And I'm going to, again, give you an example of how you might implement that. So I have a client now, wasn't a client when we first began discussing his planning. He had been fortunate. He retired at 62. He wasn't going to collect Social Security because he wanted to let Social Security defer and the benefit increase. He didn't have a pension like many of us. He had this really big 401k that he accumulated while he was working and saving. But now that he retired early, he was just living off of his savings, living off of cash and taxable investments. So his effective tax rate was almost nothing because he didn't have wages or a pension. What we determined was if we did the analysis, we could convert roughly $700,000 of his 401k to a Roth IRA over 10 years. And I see some of you have questions. That's great. I want you to put them in the chat box. We'll try to get you answers. But again, Roth conversion IRAs, unlike Roth contributory IRAs, don't have that maximum limit of, depending on your age, $7,000. And you don't need earned income. So again, you can convert whatever amount you want and are willing to pay taxes on from that 401k or IRA to a Roth IRA, and you don't need earned income. So what did we do? Well, over those 10 years, before his required minimum distribution started, we were able to project out we could do conversions, keep him in less than a 10% effective tax rate, and take that $700,000 of fully taxable money and make it tax-free. Now, what are the benefits of doing that? Well, there's multiple benefits. Number one, Roth IRAs, unlike traditional IRAs and 401ks, don't have required minimum distributions. So what did we do? We reduced what he was forced to take out over his lifetime by hundreds of thousands of dollars or maybe millions of dollars, saving him, presumably, hundreds of thousands of dollars in taxes, number one. Number two, we created an additional bucket of tax-free money to manage his taxes as we believe tax rates increase. And number three, and this relates specifically to the Stretch IRA change, when his daughter, for example, inherits this money, and again, we presume over his lifetime that $700,000 maybe grows to $2 or $3 million, possibly. When his daughter inherits that $2 or $3 million, it will be income tax free instead of fully taxable as income, possibly saving her $1 million or more in taxes. Nobody is doing this type of planning in my experience. I shouldn't say nobody, very few are. It's rare that I meet a CPA who's doing these types of projections. And that's really one of the benefits of working with us, because if you're in this situation, it's hard to overestimate the benefits that this could provide you and your family. So again, I know this is a little complex, right? I hope you're following me. Ask those questions in the chat box. The bottom line is, if you project out and do this type of planning, you may be able to create a huge bucket of tax-free money, reduce your income taxes while you're alive by hundreds of thousands of dollars or more in this example, and pass on millions of dollars to your children tax-free, as opposed income tax-free instead of fully taxable as income. So the other thing I want to mention is I'm not going to read to you every single slide here. We have a limited amount of time. That's why I've included the full presentation as a handout on your screen for you to download. Now, there is a lot to this Stretch IRA. This one item around Roth conversions, I could present a whole seminar on. In fact, I have. But what I'm going to encourage you to do today is, on your screen, there's going to be a link to schedule time with a member of our team. I encourage you to consider setting up time to have a quick Zoom meeting or phone call to get your questions answered, to get some clarity on anything we're not able to answer for you today, or with the limits of this type of presentation. So let me give you a couple other action items from the Stretch IRA change. Number one, like I mentioned, let's figure out those RMDs. Does a Roth conversion make sense? Number two, and this is important and it's missed a lot, many people in the past, when they created their estate planning, they may have written into their documents and beneficiary designations that their child or children were only entitled to the required minimum distribution on their IRA. Logically, it kind of makes sense prior to Secure Act, because what that did was it almost was a spendthrift clause, if you will. It limited the amount of money that your child, in this example, could take out of that big IRA, right? And it was a way to, again, help them be more prudent. So many documents, beneficiaries still say today, my child is entitled to the required distributions. Well, let me tell you something. One of the benefits from having dinner every night with an estate planning attorney, my wife, is that we talk, right? We talk about our days, we talk about work. And one of the things that's come up recently is the fact that the way the legislation is written with the elimination of the Stretch IRA and the 10-year rule is that it's not that the child is supposed to take out 10% a year for 10 years as the required distribution. The way it's written is the full amount has to come out by the end of year 10. So what does that mean? Let's say you haven't updated your estate plans, you haven't made analysis and provisions for this change. Well, in this example, if we assume $1 million in an IRA, prior to Secure Act, your child maybe got $30,000 a year for 30 years. Now, they wouldn't get anything until the end of year 10, and they'd have to take out the full $1 million in 1 year, probably costing them $500,000 in taxes maybe. So this is one of the reasons it's important to not only have your investment person on the same page with your tax person, on the same page with your estate attorney. And that's really one of the benefits our clients receive through an integrated approach where we have attorneys and CPAs and other professionals as partners and team members to help our clients with these areas. Let's switch gears and talk about capital gains taxes, and more specifically, what I call phantom capital gains. So this is a term you may be unfamiliar with. I don't know if I've invented it or if I heard it somewhere, but I'll tell you what, it's important. So if you're like a lot of folks, you own mutual funds. Many people do. The vast majority of the investing public uses mutual funds. And mutual funds are good for things like diversification and professional management. However, one of the big downsides of a mutual fund is that lack of tax control. So let me explain to you what I mean. When you own a mutual fund, as you probably know, you don't own those specific stocks. For example, you own shares of that mutual fund. I'm going to pick on Fidelity, for example. So if you own Fidelity Growth Fund, you don't own Apple and AT&T and IBM. You own 37 shares of Fidelity Growth Fund. So why is that important? Well, you don't pay taxes just on the profit you personally make. What happens is when that fund manager, he or she is buying or selling stocks within that mutual fund, they may be creating a lot of taxable gains on stocks they bought perhaps before you own the mutual fund or in stocks that you didn't participate in the profit of. Again, the reason that's important is because as they create these capital gains, even though you didn't make any money necessarily, you're going to have to pay taxes as if you did. Now, when we're all fighting for returns, taxes matter. So what can you do about that? Again, if you own taxable mutual funds in a taxable account, what's going to happen is typically in October or November of each year, they're going to send you an email that says, Mr. and Mrs. Client, your estimated capital gain on Fidelity Growth Fund is $7 a share. And we're going to pay out that capital gain on December 12th, for example. Well, you, your advisor, or us, somebody should be looking at that to make a decision that says, okay, should we own this mutual fund on December 12th when this taxable event happens? You know, a lot of you probably experienced it this year, 2023, because last year, because the market did what it did, you may have lost 20% in your mutual funds. And then you may have received an unwelcome surprise in March when you got your 1099 that says, hey, Mr. Client, your $100,000 went to $80,000 perhaps. And oh, by the way, here's a $10,000 capital gain that you're now going to pay taxes on. And that matters because not only the additional money in taxes you're going to pay on that phantom gain, but it also might impact things like your taxation of Social Security. So we have strategies to plan around that. And again, as we're all fighting for returns, taxes, fees, those types of things really matter. And that's part of the analysis we do for our clients. Let's switch gears again. You know, in my 25 plus years, I don't know that there's ever been a more important time to talk about this next topic, and that is sequence of return risk. Kind of an interesting term, right? So what is it? Sequence of return risk is the risk of your portfolio going down dramatically if you happen to be in the withdrawal stages of your life, like many of our clients, in the markets or your portfolio going down in value. So let me take a step back to provide a little bit more clarity on this subject. So accumulating wealth, it's not easy. We all know that. But in some ways it is simple. You save as much as you can, you live below your means, and you try not to make emotional decisions with your money. But the distribution stages, it's a whole different level of complexity. Because when you're withdrawing money, whether that's for required distributions or just to live on, you need to have a strategy as the markets go up and go down. So we're going to give you an example of how this looks for two different investors. And number two, we're going to give you some strategies on how we protect our clients against this very real and important risk. So, first example probably isn't you, right? This is a couple 40 years old, 41 years old. Example A, example B. They worked hard. They started with $100,000. In both examples, and this is important, they have the same number of positive years, the same number of negative years, and the same returns in those positive and negative years. The only difference in these examples is in example A, they happen to have more negative years up front versus example B, where they happen to have more positive years up front. But that order or sequence of returns, it simply doesn't matter because when they get to ages 65, they both have the same amount of money. They both averaged 8%. So really no big deal on those sequence or order of returns. The next scenario is much more like the clients we work with and an extremely important example to try to wrap your head around. So in this example, A and B, they both start with roughly $685,000. Like the prior example, they have the same number of positive years, same number of negative years, and the same returns in those years. However, the sequence or order of those returns, because they're in the withdrawal stages, has a much bigger impact. So in this example, they're living off of roughly 5% a year of their portfolio. Well, in example A, they're out of money. They're out of money around age 82, where in example B, they have over $2.6 million. It's a huge difference. those order or sequence of returns. So let me bottom line this for you, if you will. If you are drawing money and you don't have a good strategy that you can articulate, that you understand on how to generate income when the markets happen to be going down, you may be putting yourself at risk of having less money or running out of money. This is a core function of what we do for our clients, in that we work primarily with retirees, and many of them are generating income. I'm going to give you what I think is hopefully a simple strategy to understand on how we provide for this risk. Here's another example of retiring at different years. One retires in 1973, the other retires in 1974. They both start with $500,000. However, after 30 years or 35 years, one of them's out of money in year roughly 23, while the other one still has money a decade plus later. Why is that? Well, the first one happened to retire when the markets were going down, right? Versus the second example where they retired when the markets weren't going down. So again, that order of returns, that timing of when you retire, that luck, unfortunately, so to speak, for some, really is important. And here's how we help clients address that. We call it a bucketing approach. Again, hopefully simple to understand. All of our clients that we work with that are drawing income, what we do through our planning is we figure out, okay, how much money do they need in what we call the now bucket, which might be those first 2 years of income needs. And we keep that extremely conservative, maybe in a high yield money market account, a CD, something else that's very safe. And then what do they need for the soon bucket? These are their income needs from years 2 through 10, for example. We invest that a little bit more moderately. We try to outpace inflation without taking as much risk as the market. And then we have our later bucket, which we're not going to touch for at least 10 years. And that gives us the opportunity to ride out these ups and downs. So what does this simple approach does? Well, it allows our clients to sleep better at night because they know their short-term income needs are in a very safe bucket, so to speak, so that they don't have to worry about these day-to-day, week-to-week, month-to-month ups and downs. And then we have a strategy for refilling these buckets for soon and later. Again, hopefully simple to understand, extremely powerful in application. In addition to that, the clients that we work with, when they log into their online portal, next to each investment strategy, it will say bucket 1, bucket 2, or bucket 3. So they know the now bucket is bucket 1, and maybe the later bucket is bucket 3. So even though the market or bucket 3 might be down 10%, for example, they're confident because they know their now money is positive or at least a lot more conservative. So that's one of the areas that we can help analyze for you. All right, I want to make sure that you caught a couple of the things that we talked about so far that are really impactful, really important, and specific strategies that you can implement. Before I get into some additional areas. Number one, those Roth conversions, if they make sense, they're huge. There's a huge benefit to them. Number two, let's figure out those RMDs. Is there a way to minimize them? Number three, let's avoid those capital gains, right? Why should we be paying taxes on money we didn't make? Number four, and this one's really important, and we're going to get into it in a little bit more detail soon. If you're giving money to charities, let's get some type of benefit from your existing charitable intentions. So with that said, I'd like to give you a specific strategy, one of my favorites. We do a lot of these every year. So it's called the Donor Advised Fund. Maybe you're familiar with it, maybe you're not. What this does, it allows you, depending on your situation, to possibly get a massive tax deduction, maybe in a year that you need it, without giving more than you had originally planned to give to charity in the first place. That's called the Donor Advised Fund. So let me explain to you how that works. And I'll do it by giving you an example. I had a client recently who had a big taxable gain from selling his business. He also had some very highly appreciated stock that he bought a long time ago. Him and his wife were already charitably inclined and gave, just to pick a number, let's say $30,000 per year to charity. He was getting a little bit of a tax deduction, but nothing significant given his income level and what he would already get just by taking the standard deduction. Well, what we determined by doing the planning and first figuring out that he and his wife were going to be okay for retirement is we were able to transfer a large amount of this highly appreciated stock into a donor advised fund. What that did was it allowed him to get a massive tax break by avoiding capital gains on that appreciated stock. In addition to that, he structured the donor advised fund to give out roughly $30,000 a year in cash to multiple charities. Now he gets to change that every year, but his first year, he was just going to give the same amount he had originally planned on giving in the first place. So what did he accomplish? Well, number one, he's not giving more to charity than he originally planned. And let me just pick some numbers to make this make more sense. So in this situation, he transferred $600,000 of appreciated stock into a donor advised fund. Because his income was so high because of that taxable event, he got a $600,000 tax deduction in a year that he really needed it. Then he'll instruct us to pay out, for example, $30,000 a year for the next 20 years. So what did he accomplish? Again, big tax deduction, avoided capital gains taxes, wasn't giving any more money to these charities that he originally intended. This type of strategy is really flexible. I'm giving you a big number just to help illustrate the power of it, but just know you don't need to give a huge amount of money. Perhaps you only give $5,000 a year, only in quotes, and you get no tax deduction. Well, maybe we can transfer $50,000 of stock or cash into this donor advised fund, and we can structure it to pay out that same $5,000 a year for the next 10 years. The whole point is you're getting a major tax deduction possibly in a year that might benefit you, that maybe allows us to do some Roth conversions and have that be more impactful. The charity gets the same amount of money and you don't give any more than you'd originally planned. That's called a donor advised fund. We do it all the time. We can get you more information on that if you want to speak with us. So let's switch gears. Social Security. I'm going to begin with a question. Is Social Security taxable? Go ahead, take a second, put it in the chat function. Okay, yep. Yeah, almost all of you said yes. Well, it's a trick question. The answer is it could be, and it's all based on something called provisional income. So what is provisional income? Well, let me tell you the components of that. Provisional income, again, dictates whether or not your Social Security is taxable or what rate it's taxable. So the way that you determine your provisional income is you take half of your current Social Security benefit, you add in ordinary income, which could be wages, pension, perhaps interest on CDs. Then you add in those dividends and capital gains. Remember those phantom gains? This could be a reason why that's important. And finally, non-taxable interest, which is municipal bond interest. Excuse me. You add up those four components and that determines your provisional income. If you're married filing jointly and your provisional income is less than $32,000, your Social Security is not taxable. If it's between $32,000 and $44,000, half of your Social Security is taxable. And if it's above $44,000, 85% of your Social Security is taxable. So again, we can do some of the analysis. Oftentimes we can keep our clients in a lower tax rate, possibly saving them from all or a portion of their Social Security being taxable. Let's switch gears again. And I'm going to refer to what we call the client value ladder. So what is that? Well, our firm, we speak with a lot of folks. We see a lot of things. I've literally had thousands of conversations around financial planning, and I'm shocked that I still see what we call basic financial advisors, and that is advisors who are just focused on those first 3 circles at the bottom of the pyramid. Many advisors, they focus just on picking the right fund managers, investment managers. Maybe they do some rebalancing, perhaps they provide some additional analysis, and that's kind of where the value stops. That's not enough. You might think your situation isn't complex, but the world we're in is complex. We think the most basic or the foundation of any good financial advice should, yes, obviously include those 3 circles, meaning having good outcomes given your level of risk. But what makes us somewhat unique is we also do the in-depth insurance analysis without having a product to directly sell you. So we'll look at the long-term care analysis. We'll look at the life, the disability, the umbrella policies, the Medicare. We have a team that will do all that analysis for our clients, and you can feel confident that we are doing it as true fiduciaries objectively. Next, obviously, we're going to look at generating income. Most of our clients are probably like you, retired or close to retirement, and generating income safely and having strategies around that is extremely important. Next, taxes. That's why you're here today, and we are uniquely positioned to help you make sure you're doing everything you can to save the most amount of money in taxes and not pay more than your fair share. We have tax preparers and CPAs on our team. I've owned a tax planning firm. Every client we work with, we do proactive tax planning. In fact, I'm going to show you a sample tax report before our time ends today that you can have if you get us the information we need ahead of time and choose to meet with us. Once we have that foundation built of managing the money, protecting you from an insurance standpoint, generating income, proactive tax planning, then we can feel confident of moving on to the second layer of this client value ladder. And I'm just going to pick a couple examples. One is estate planning. I don't know of any other financial advisor that is married to an estate planning attorney, let alone is integrated with her firm and has dinner every night with her to discuss how we spend our days on wealth management and estate planning. You'll benefit from that coordination and teamwork. Charitable intentions. We spend a lot of time on this, helping our clients effectively and efficiently give what they want to the organizations that are important to them, while, if possible, getting a tax benefit. Once we get through that layer, we think you'll feel more organized, in control. We want to simplify your life so you can feel you're living your life's purpose. So that's really what we do for a select group of people, most likely just like you. You came here today possibly with some very specific concerns. Maybe it was the required minimum distributions, maybe it was understanding capital gains taxes, or perhaps some of the changes from the Secure Act. I hope I gave you information on that, but I want you to realize your life, like all of ours, may be an iceberg, right? You just are thinking about or seeing what's right on top. But because this is our life's work, we do it every day. When we meet with people, we're able to help them understand all the areas of their life with a focus on taxes. Really, tax planning and estate planning is a huge part of the benefit our clients get from working with us. So I just want you to realize you might have came here for one specific concern, and I hope you put that in the chat box. We'll make sure and get you an answer, but hopefully you see you may benefit from a much more comprehensive approach. So every client, switching gears, every client that we work with, we provide them this tax report, and there's an example there in the handout. What it is simply this. We'll take your last year's tax return, compare it to a projection of this year, maybe next year, maybe multiple years from now. There's a lot of things going on in this tax landscape that are impactful. There are not only the current tax legislation, but in 2025, a lot of tax benefits from the 2017 Tax Cuts and Jobs Act gets rolled back. Might it not make sense to see how that impacts you ahead of time? So again, this tax report, it's very straightforward in that it gives you kind of all the most important areas that you want to look at: effective tax rate, Social Security taxation, income, marginal income. But then not only does it give you these key indicators, it tells you what areas might you qualify for to save money in taxes, and most importantly, are specific observations. So once again, I hope you're getting some good information today, but just know, if you think you'd benefit and we think it makes sense, we can provide you this report as well. That might give you specific observations and strategies to your situation. All right, does this stuff matter? Yes, it matters. It matters a great deal. In fact, here's a simple example of some planning that we might do for a client that implements a Roth conversion strategy or some other strategies, and it equates to possibly millions of dollars and more wealth for his family or her family, or, and this is maybe most important, gives them the confidence to take that extra vacation, to do that gifting to their grandkids, to give money to charity. So we lay it out for you in a simple to understand way. We hit those different toggles of areas that we can provide benefit to you. And then in black and white, we show you the benefits of this type of planning. And let me assure you, for the types of clients we work with, if we can figure out how to decrease their effective tax rate over time, get more money tax-free, reduce the expenses in their investments, maybe create some after-tax return by more tax-efficient investments. Depending on your level of wealth, it really is the difference, in my experience, between feeling okay, like you'll probably be okay in retirement, and confident to live your best life. And that's what we do, again, for a select group of people. And I hope you give us the opportunity to speak with you about that. So I gave you a lot of strategies today. I really did. Again, the whole presentation is in the handout. I hope you've been using that chat box, getting some questions answered. I just want you to know it's a lot of information in a short amount of time. You'll have the opportunity to schedule a phone call or Zoom meeting or in-person meeting with a member of my team and get your specific questions answered. There's a lot here. I'm going to go through and just hit some bullet points quickly before we finish up our time together today. Number one, some simple stuff like, let's figure out if we can take some profits tax-free, because capital gains rates are different than ordinary income rates. Number two, let's calculate those required minimum distributions. If there's a way to minimize them and that makes sense for you, the tax savings could be massive. Number three, let's review those estate documents. Let's make sure that everything aligns properly from a tax, ownership, and beneficiary standpoint, so you don't delay perhaps the inheritance of your kids longer than you thought. Number four, check those mutual funds. Let's figure out if there's a lot of embedded gains that are going to cause negative tax repercussions, if there's some things we can do to help minimize those taxes. Also, if you're taking income, let's make sure you have a strategy on how to generate that income safely. Next, if you're charitably inclined, should you be using a donor-advised fund to amplify the tax benefits without giving more than you originally intended? There's so much more I could go into: active tax loss harvesting, qualified charitable distributions. the right type of IRA, Roth IRA, SEP IRA, simple IRA. It's just so much. And I look forward to the opportunity to have me or a member of my team tell you specifically what areas are going to help you the most, and then show you in black and white how that would work. So those are a couple quick bullet points. And if you're still with me, thank you. I mean, I just want to compliment you. Not many people take time out of their day to spend an hour on tax planning, right? So the fact that you're doing this tells me that you're serious about doing what's best for you. What I encourage you to consider is setting up a time to speak with one of us in one of our convenient offices in Pittsburgh, perhaps over the phone or in a Zoom meeting. I have a great team of professionals here locally. I have a larger group of professionals. There's really no financial issue, most likely, that you have that we haven't seen and can't help with. So again, consider setting up that appointment. There is a link on your screen to do it very simply. You'll just set up first an introductory call with a member of the team, and then we'll have a meeting at a convenient location and time for you. So what's going to happen in that first meeting? Well, as I mentioned, number one, it's all about providing you education and value. You don't have to get us anything ahead of time, but if you do, you might get more benefit from our time together. Number two, and this is extremely important, no one's going to try to sell you anything when we meet. It's a multiple step process before we decide that you're a good fit for us, and obviously before you decide if we're a good fit for you. So take that first step, schedule that meeting. I promise you'll learn something new. You'll have a good experience. You'll get something valuable from the meeting. And if nothing else, you'll have some confidence around what you're doing. You might be thinking to yourself, well, I don't really have my calendar. Hey, that's okay. We'll make it easy. There's a lot of time on that link for that introductory call before the first meeting. Number two, you might be thinking, I really should think more about everything I talked about. Yeah, please do. Read the presentation, visit our website, read our reviews, do your research before you spend any of your valuable time with us. Or number three, you already have an advisor. Almost every client we have today had an advisor before they started working with us. What we found is almost none of those advisors not only had the sophisticated investment strategies for this environment with a way to safely generate income, but did the proactive tax planning, had the estate integration, and the objective insurance analysis. So if you have an advisor, don't let that hold you back. I really appreciate our time together today. I had a lot of fun. I hope you got something out of it. One last time, please enter in some questions into that chat box. I'm going to try to answer some before we wrap up. I see a few questions in there now, so I'm going to go ahead and read those and hopefully get you some answers. Okay, so here is a question from Lance, and Lance wants to know he wants to understand if he qualifies for a Roth conversion based on the amount of money he makes. Well, Lance, the good news is this. Roth conversions, unlike Roth contributory IRAs, you don't need earned income and you don't have a limit on how much you can convert. Now, I'll tell you, it depends, right? I mean, the way that Roth conversions make a lot of sense is when you can convert at a relatively low effective tax rate. All right, I see another question. Okay, so this question is from Mark, and Mark wants to know more about the process. So the process is this. It's a quick 15-minute phone call to get your questions answered. So there's no reason not to do that phone call, and I hope you schedule that today. After the phone call, depending on the outcome of that phone call, we'll determine if we should meet again at a convenient location for you, whether virtually or in person, to get you some additional information. After that next meeting, it's up to both of us if we want to meet again And eventually, typically over 4 to 8 weeks, we can make a decision if there's a benefit to us working together. All right, I don't have time for many more questions. I see one more here from Danielle. Danielle wants to know if there are minimums in the type of folks we work with. Well, candidly, Danielle, we do work with people with complexity because those are the ones that are going to get the most benefit from the type of planning that we do. So for us, complexity does mean a certain level of assets that we can discuss in more detail. I will tell you as a firm, we do have a minimum of $500,000 before we can accept any client as a firm. And I tend to work with clients with a higher level of assets and complexity. All right, I don't have any more time. We're at the end. I had so much fun. I hope I answered some of your questions. Come and speak with us. I hope you have a great day. Thank you so much for listening. Be well. I hope to see you soon. Bye-bye.